Welcome back. In light of some recent market weakness, I thought it'd be a good idea to take a look at the VIX. This is a volatility index. Essentially what it is an index that's comprised of the front options, the front month options on the S&P 500. Now, as the S&P 500 goes down, the options, the premium on those options rise. As a result of more expensive puts that traders may buy as protection, or if traders decide to sell covered calls. So the VIX essentially moves in the opposite direction of the S&P 500. It's also called the fear gauge. Over here we see the blue line. The blue area chart is the S&P 500 and the white line is the VIX. So we can see there's almost a perfect inverse correlation. When the S&P 500 goes down, the VIX goes up. When the S&P 500 goes up, the VIX goes down. Recently, we've seen a spike in the VIX moving from the 18 level all the way up to highs of 27. Intraday, actually even a little bit higher than that, around the 30 level the other day. Take a look at the S&P 500. That's the white jagged line. The VIX is shown here by the purple histogram bars. When the S&P 500 goes up, we see the VIX remains near the lows around the 18, 19, 20 level. Conversely, when the S&P 500 goes down, we see these histogram bars spike higher. We can compare this also to the moving averages based on the S&P 500. The red line is a 20 simple moving average. The yellow line is a 90. The reason why we included the moving averages is to demonstrate overall when the market tends to trend higher. So we can see here towards the latter part of January, early February, when the S&P 500 rallied higher, the red line, the 20 simple moving average, trended higher and separated from the 90 simple moving average, the yellow line. And during that period of time, the VIX remained again near the lows. 18, 19, 20 are considered to be lows, pretty significant lows for the VIX. It's gone even actually lower than that at times. But conversely, now that we have a lot of market weakness as of late, see the VIX is spiking higher as the simple moving average, the 20, crosses back below the 90. The red crosses back below the yellow. Now, take a look at the chart here. This is 2020 when we saw that massive market sell-off. The white dotted line here is the S&P 500. Again, the VIX is shown here by the purple histogram bars. Notice how as the stock market really crashed, March, April of 2020, the VIX spiked to levels high near the 80 level. That's a very unusual point. Usually readings above 40, 50, or even 60 are considered to be very oversold for the stock market. An 80 level is extremely rare, which is what happened in 2020. And we can see obviously the red line, the 20 simple moving average, crossed sharply below the green, the 90 simple moving average. Now, if we take a look at the VIX, now this is data going back to the year 2014, about 10 years of data, 9-10 years of data. We see here, these are the most common levels of the VIX. If you take a look at the closing price of the VIX every single day, these are the levels where it tends to close at the most. The 10 to 15 level, between 10 to 15 on the VIX, that represents 35% of all the closing days for the VIX. Between 15 and 20 represents another 27%. Between 20 to 25 represents another 18%. So if we take 35, 26, and 18, we're talking over 50%, actually even more than that, of all the VIX closes were contained between 15 and 25. These are the very common levels. There really isn't much of a trading signal when you see VIX 10, 15, 20, even 25. But when we start to see the VIX cross below 10 or above 25, 30, then we start to see more promising futures as far as our ability to perhaps prognosticate what will happen. Here we see the returns. The 7-day return is shown by the purple histogram bars. The red shows us the 30-day return. The green histogram bar shows the 90-day return. Now the black line shows us the 90-day average, and the yellow line shows us the 30-day average. The averages of what? These are the averages of the S&P 500. If we were to close our eyes and buy the stock market at any random time, overall, over the next 30 days, statistically speaking, our results show, the data suggests that we have about a 1.1% return on our investment. Meaning if you buy the S&P 500 at any random time, you make on average about 1% over the next 30 days. If you hold it for the next 90 days, a quarter of the year, you make on average 3.2%, which makes sense because the S&P 500 on average will make around 10 or 12% for the year, sometimes a little bit more or less. However, if we wait for those particular moments when the VIX is at certain levels, the data shows us that we can expect to make sometimes a significant amount more. So for example, when we see the VIX at a 20 level, the 90-day, which is the green line again, the 90-day return on investment is around 4%. But remember, the average 90-day return is 3%. So you make a little bit more if you only buy the S&P 500 when the VIX is at the 20 to 25 level. If you buy the S&P 500 when the VIX is at the 25 to 30 level, you average around 5%. But take a look at this. If we only buy the VIX, or we only buy, I should say, the S&P 500 when the VIX is between 35 and 40, on average, for the past 9 years or so, the S&P 500 returns around 13%. If we're to buy only between 40 to 45, the data shows us around 18% return on our money. Now, we see levels up 70, 75, 80, which certainly could be a lot more, but this is a very small amount of data. It is very rare for the VIX to hit 80. It's only done so perhaps a few times in the past couple decades. More than likely, we're not going to see VIX levels above the 40, 50, at the very most 60 level. But if you wait, for example, when the VIX is between 55 and 60, the data suggests that we make a 26% return on our investments if you hold the S&P 500 during that period of time. So it really does behoove us to buy the S&P 500 after it's gone down a lot. How much? Well, when the VIX goes up to these levels, 40, 50, 60. Then we take a look at here. This is the weekly point change. How much does the VIX have to move within a week? Because sometimes, we don't see 40, 50, 60 VIX levels. Maybe we only see a 25 VIX level, but it had a spike during that period of time. Well, this shows us overall our 7, 30, and 90-day return based on the S&P 500 if we were to buy it after the VIX makes a big move. So, for example, if the VIX moves up 5 points, quickly within 1 week, that's 5 trading days. On average, if we hold the S&P 500, it returns us around a 7.5% return on our investment. So again, we're not always going to see VIX 40, 50, 60. Those returns are actually, those levels are actually quite rare. Again, the most common levels are VIX 10, 15, 20, 25. Seeing a 30 VIX is not usual. So what do? If we only see a VIX 25, which is, more or less where we are now, well, we would wait for a spike. And if we see the VIX, let's say at 25, but that's the 25 and it's gone up 11 points in the past 5 days, it's gone from a 14 to a 25, a huge spike up. That would be a significant market crash. Chances are, at least this is what the data suggests, is that we're due for a reversal. Stocks go back up, VIX goes back down, and the data shows us we're on a 17.7% return on our investment in the next 90 days buying the S&P 500, again, after the 11-point spike in the VIX. So we don't always need to wait for a VIX 40, 50, 60. But if we do see a very big spike, now conversely, if we see the VIX really sell off, let's say the S&P 500 goes down, goes up a lot. S&P 500 goes up, the VIX collapses. Let's say the VIX goes down 8 points in 1 week. That shows us the stock market's up a lot. Well, the stock market now has a very good chance to follow through. The next 90 days actually returns a 16.3% return on investment, meaning when the S&P 500 breaks out, it has a very good chance to actually continue higher. But this only occurs, this phenomenon only occurs if we see a VIX in 5 trading days going down 8 or more points during that period of time. If we see the VIX is down 5 points or up 3 points, this actually teaches us a very important lesson to sit out those trades where the statistics are not on our side. And if we see quiet markets, quiet VIX readings, VIX at 15 and a very, very small amount of movement, then perhaps it's good not to place a trade just because the data doesn't suggest any sort of dependable trend. Going back over the past 5 days, and these are the closing prices. This is actually as of March 14th. We see here the red line is the S&P 500. The blue histogram bars are the VIX levels. We did see on the 13th, a VIX hit a high. I believe intraday it was right around 30. But then settling over at 27. So we are in an area where we're starting to seeing a little bit of unusual VIX readings. But again, VIX readings above 30 are really less common, as we can see over here. But we're going to continue to watch these levels and the overall market trend very closely. And we'll be sure to update you along the way. We hope this has been helpful. We look forward to seeing you back soon.